Yes, today we are going to see one of the company ratios, interest cover. So, what is interest cover? It is a number of times. Interest is paid out of operating profit. It is a number of times. It is the number of times interest is paid out of operating profit. It can be calculated by the following formula. Interest cover is equal to profit before interest over interest. The answer should always be in terms of times. So, interest cover, it is a number of times interest is paid out of operating profit. It can be calculated by the following formula. Interest cover is equal to profit before interest over interest. Now, note the standard interest cover ratio should be 2 times. This is a standard interest cover, 2 times. If a company get an interest cover of less than 2 times, so it means that the company is experiencing problems in paying interest charges. If it get an interest cover more than 2 times, so it means that the company can pay its interest comfortably. So, let's see an example. Of interest cover. So, interest cover 2 times. This has already been given. And profit before interest. $200. So required calculate interest. So we have to replace in the formula. Interest cover is equal to profit before interest over interest. So we replace. What is interest cover? 2 times. What is the profit before interest? $200. So interest we cross multiply. So interest is equal to, in this case, interest is equal to $100. So it means that 50% of the profit has been paid in terms of interest. So that's why we say that the interest cover should be 2 times. Before profit before interest has been given 200, and we are required to calculate interest. So interest is 100 out of the profit of 200. It means that 50% of the profit is used to pay interest, and 50% of the profit will be left for reinvestment purposes in the business or to pay dividend to shareholders. That's why it is important that we have an interest cover of 2 times. So the interest cover ratio should be 2 times. Now, we can write it down. An interest cover interest cover ratio of 2 times means that 50% means that 50% of operating profit has been used to pay interest charges and 50% profit will be left for reinvestment in the business or to pay dividend to shareholders. So here we are. An interest cover ratio of 2 times means that 50% of operating profit has been used to pay interest charges and 50% of profit will be left for investment in the business or to pay dividend to shareholders. So if interest cover is low, that is below 2 times, so it means that the company is experiencing problem in paying interest charges. So in this case, if the company cannot pay interest charges comfortably, so less profit will be left for reinvestment purposes and to pay dividend to shareholders. So in this case, if a company has an interest cover ratio less than 2 times, so ordinary shareholders may run the risk of not obtaining dividend, and in this case, potential investors may be unwilling to invest in the business. So a low interest cover will discourage investors to invest in the business because they run the risk of not obtaining dividend. So let's see low interest cover. Low interest cover. What is the implication of low interest cover? A low interest cover indicates that the business is experiencing difficulties in paying interest charges. In this case, less profit will be left for reinvestment purposes and to pay dividend to shareholders. In this case, potential investors may be unwilling to invest in the company as they run the risk of not obtaining dividend. This means their investment their investment will be at risk. Here we are. Low interest cover. So what is the implication of a low interest cover? It means that the company is experiencing problems in paying interest to debenture holders or to loan creditors. So in this case, a low interest cover indicates that the business is experiencing difficulties in paying interest charges. So most of the profit will be used to pay interest charges, therefore less profit will be left for reinvestment purposes and to pay dividend to shareholders. In this case, potential investors may be unwilling to invest in the company as they run the risk of not obtaining dividend because less profit will be left to pay dividend. Most of the profit will be used to pay interest charges. This means that their investment will be at risk. So in case a company has a low interest cover, so it means that the company will be unwilling to invest in their business because the shareholders will be unwilling to invest in their business because they run the risk of not obtaining dividend. Now let's see higher interest cover. Higher interest cover means that the company can pay its interest comfortably. Higher interest cover, high interest cover. A high interest cover indicates that the company, the business, can pay its interest charges, comfortably, thus more profit will be available for reinvestment and to pay dividend to shareholders. Hence, potential investors will be motivated to invest in the company, in the business, as they will get dividend. Their investment will not be at risk. So this is the implication of a high interest cover. In case a business has a high interest cover, it means that it can pay its interest charges comfortably. Therefore, more profit will be available for investment and to pay dividend to shareholders. And potential investors will be motivated to invest in the business as they will get dividend. Their investment will not be at risk. So we are going to make a recapitulation of what we studied so far concerning interest cover. Interest cover indicates the number of times interest is paid out of operating profit. It can be calculated, that is, interest cover is equal to profit before interest over interest. So the standard in interest cover is 2 times. This means that 50% of the operating profit will be used to pay interest charges and 50% of profit will be available to reinvest in the business or to pay dividend to shareholders. In case a business has a low interest cover, It means that the business is experiencing problem in paying interest charges to debenture holders and to loan creditors. So in this case, less profit will be available for reinvestment purposes and to pay dividend to shareholders. Hence, the potential investors will be unwilling to invest in the company as they run the risk of not obtaining dividend in the business. Conversely, a high interest cover ratio indicates that the business can pay its interest comfortably. That is, more profit will be available for reinvestment purposes in the business and to pay dividend to shareholders. In this case, potential investors will be willing to invest in a company where the interest cover is high because they will get dividend. That is, they do not run the risk of their investment will not be at risk. So here we are so far concerning interest cover ratio. So it's very easy for comments on this ratio. You just have to take into account if it is below the standard interest cover ratio, that is less than 2 times, it means that the business is experiencing problem in paying interest charges. So in this case, less profit will be available for reinvestment purposes and to pay dividend to shareholders. Potential investors will be unwilling to invest in the business as they run the risk of not obtaining dividend. Conversely, a high interest cover indicates that the business can pay its interest charges comfortably. That is, more profit will be available for investment purposes and to pay dividend to shareholders. Potential investors will be willing to invest in such company and therefore they will get dividend and the investment will not be at risk. Now we are going to see a computation of interest cover. Example, we have company A and company B, and we have operating profit for company A 120,000, for company B 280,000, and interest, we have interest charges to pay 80,000, and this one we have interest charges to pay 50,000. So this is the information given. So we have to calculate interest cover, calculate interest cover for both companies, A and B. Very easy. We have to apply the formula. Interest cover for company A. Interest cover is equal to profit before interest 120 over interest 80,000. This will give us an interest cover of 1.5 times. And for company B, we have interest of operating profit 280, interest 50,000. So this will give us 5.6 times. 5.6 times. So here we are. For company A, the interest cover calculated is 1.5 times. For company B, 5.6 times. So in this case, company A is not in line with the standard interest cover ratio of 2 times. It is less than 2 times, so it means that it is experiencing problem in paying interest charges. So in this case, most of the profit will be used to pay interest charges and less profit will be available for reinvestment and to pay dividend to shareholders. So company B has an interest cover of 5.6 times, that is more than the standard interest cover of 2 times. So in this case, company B can pay its interest comfortably, and more profit will be available for reinvestment and to pay dividend to shareholders. So we have to criticize very easy the comments on these two companies. Here we are. So how we are going to comment on these two ratios? Company A has an company A has an interest cover of 1.5 times or 1.5 times, and company B has an interest cover of 5.6 times. This means company A is experiencing problems in paying interest charges comfortably, and therefore more profit is used to pay interest. Hence, less profit will be available for reinvestment and to pay dividend to shareholders. Hence, thus potential investors will be unwilling to invest in company A, as their investment will be at risk. So here we are, so far concerning this question, how to comment on this question. So company A has an interest cover of 1.5 times and company B has an interest cover of 5.6 times. This means company A is experiencing problems in paying interest charges comfortably, and therefore more profit is used to pay interest. Hence, less profit will be available for investment and to pay dividend to shareholders. Thus, potential investors will be unwilling to invest in company A, as their investment will be at risk. So, now we have to comment on company B as well. So, why company B? Why people will invest in company B? Company B has an interest cover of 5.6 times. Company B has an interest cover of 5.6 times, which is greater than the standard interest cover of 2 times. This means This means the company can pay its interest charges comfortably, and therefore more profit will be available to pay dividend to shareholders. Hence, potential investors will be encouraged to invest in company B. So here we are for these comments. Many students find it difficult to comment on interest cover ratio. Now, I think that it is clear in your mind that this ratio is very easy. An interest cover ratio indicates the number of times interest is paid out of operating profit. The standard interest cover ratio should be 2 times, that is 50% of the profit will be used for reinvestment purposes and 50% of the profit can be used to pay dividend to shareholders. So the 50% of the profit can be used to pay interest charges and 50% of the profit will be left for reinvestment purposes and to pay dividend to shareholders. So here we are concerning interest cover ratio.